Hello, everyone, and thank you for dialing into for this quarter's webinar. So my name is Phil Tiley. I've got Robbie Tangen, who's head of our kind of wider global advisory business. I'm head of performance valuation, data analytics here at ODCE, and we're here to take you through the latest set of ODCE performance numbers. Apologies, a couple of logistics. We did move the data around, realizing that there was this and the NCREIF one when they're talking purely to the MPI on the same date. So that one is tomorrow. This one we must move forward to today. So this one was specifically talking to the returns on the ODCE index. That's the 25 ODCE funds. And we're applying alongside that the valuation data that we're aggregating ourselves to provide added insight into those market trends. So the webinar, it's part there for kind of our whole network of clients to get an understanding of trends in the marketplace. It's partly a precursor to the analysis conversations we have with our clients on a one-to-one basis, and we look forward to those conversations in the coming weeks. And we're actually looking to be extending out those kind of conversations to clients that just work with us on a pure valuation basis as well. So more to come around that. But before I pass over to Robbie, thanks very much everybody who's involved in this process, because I know there's a lot of data that was being pulled together, both within ODCE, our clients for providing us with access to their data, NCREIF themselves providing us with access to the benchmark numbers. But without further ado, we have a number of polling questions as we go through this, so I'll pass over to you, Robbie, with the first of those. Good to have you on the call there, Robbie, as always.
Thanks, Phil. So before we start, right, so just kind of a reminder, right, so if there's any question during this webinar, please enter them in the question box, right, so we will try to address all the questions at the end of the webinar. If we cannot address all of them, we will address them after the webinar. So every quarter we ask this question, right, so what do you expect the total unlevered property return to be in 1Q, right? So majority of the attendee like basically indicated B, which is -2 to +1, which is 0 to 3%, and then 40% -4 to -2%, right? So I think, Phil, they're correct, right? So I think the B is on the lower end of it is kind of correct, even C is not too far off, right? So
yeah, and the majority of people were in the right bracket there, but as you say, the lower end of it. So let's get straight into the actual numbers here. So here we're showing this the performance series total return, confirming that after what was a comparatively large setback at the closing part of last year, the level of decline did ease off in the opening 3 months of this year, obviously posting a return there of -1.5%. So the market's still very much on a downward trajectory. That's the ODCE now posting its 6th consecutive negative quarterly rate of return. And just to clarify, we're reporting here on just the pure real estate side of the ODCE. So there's no cash, no fees, no leverage in here. This is just how the pure real estate side of the ODCE is played out. We're taking the time series back pre-COVID, so just over 4 years ago, when returns did turn negative just for that one quarter before embarking on this kind of unprecedented growth period. Returns then reaching record highs in the high 6s. You then have a change in the interest rate environment, and that growth is now being effectively reversed back out again. In terms of the levels, that latest return at -1.5 isn't that dissimilar to where the market settled out in Q3 of last year. So the results are looking as if they are now once again heading back, thankfully, in the right direction. Let's move straight into unpacking those numbers. So here we're unpacking the performance series into income appreciation levels leading up to the pandemic. You can see that real estate was providing a pretty consistent income return with a portion of appreciation to its investors quarter over quarter. That whole performance profile has been kind of turned on its head over the last 4 years, certainly from an appreciation standpoint, pulled one way and the other. We've broken that down into 3 kind of key periods. We've talked about these before. You have the write down at the onset of the pandemic when values were down just around 2.5%. That's pretty minor now, that in the wider scheme of things. That was then followed by 7 consecutive quarters of growth during which just shy of 23% was added to the value of the real estate funds, and now 7 consecutive quarters of declining values. And if you compound those appreciation numbers up, values overall are down 3.7% below where they were at the start of the pandemic.
Bill, with 7 quarters of decline in value, how are these compared to GFC? I know the fundamentals different. We're just kind of curious on GFC time, and also the magnitude of that decline. How does that compare?
Yeah, we actually talked about this the other day, didn't we? So yeah, that downturn, they were now at 7 quarters. That downturn lasted, I think it was 9 quarters, during which values were down 33%. I'm quoting those numbers off the NPI and not the ODCE, by the way, but we'll kind of confirm back on that. So 33% decline. So I suspect we won't hit those depths. Clearly, there was a big difference, as you say there, Robbie, when real estate was part of a wider set of economic and fiscal challenges that kind of shook all aspects of the investment arena and kind of really all aspects of real estate. We've now, as we'll show through today, more of a mixed picture. Whether this period extends out to 9 quarters, I guess, remains to be seen. But for now, I guess that current period of decline is easing off once again. And then I guess what we're able to provide within Alters is added insight into the makeup of that appreciation piece by drawing on our actual valuation data sets. So we can determine how much that movement in value that we're now seeing and have been seeing is a product of the pure kind of economic fundamentals versus what might be termed the investor sentiment and more the kind of capital markets side of the appreciation. So listeners, well, regular listeners will be fairly familiar with this drill. So what we first do, we transpose the red bar there onto the red line on this next chart and then bifurcate that appreciation into what we term the yield versus the cash flow effect. So the yield, which is the yellow bars, is how much movement in value is dictated by the change in the actual valuation yields. That's movements in discount rates and exit caps. The cash flow, the blue bars, are the impact on the change in values from the change in those forward projected cash flows that are effectively being priced by those yields. So this kind of whole current period of correction has been characterized by real estate continually being repriced in response to change in the underlying interest rate environment against, I guess, let's call it an uncertain economic backdrop, and that's certainly what we've been seeing playing out in those yield and cash flow effects. But the makeup of that downturn has certainly altered as we entered into the start of this year. Yes, yields, the yellow bar, is still pulling back on values, but at less so than at any point in the last 18 months. And that's in the absence of the Fed making any rate cuts so far this year. And in fact, the 10-year Treasury, I think, has actually been moving out in the opening quarter of the year. So I guess, Robbie, with that yield effect easing off, do you get a sense of optimism, based on these numbers, that kind of, call it, current period of repricing may be nearing a close?
Yeah, there's no easy answer on this one, right? I think that there's various conflicting view or information on this, right? So if you look at an interest rate and economic perspective, there's still to be appear like a downward pressure, right? So if you look at it, rate cut is not coming as early as market initially priced or anticipated. Like I think beginning of some point it was anticipated 6 rate cut, and now it's 1 rate cut, right? So the 10-year Treasury moved from a 3.9% in the beginning of the year to 4.2 to 4.3 at the end of the year. It's currently sitting about 4.4 to 4.5, right? So that's after hitting 4.7, right? So because the inflation has still continued to be elevated. And then there's a mixed signal from the various kind of economic indicator, right? So from that front, there's still to be a downward pressure, right? So on the other hand, if you're trying to look at it, the recent transaction and investor sentiment perspective, the bid have been more competitive to start the year compared to the end of last year, right? So we also saw a large deal coming into the market, right? So we saw the Rexford, the IRC deal, right? So, and many of the deals, especially in the industrial apartment, they have numerous bids, not just 1 or 2 bids. There's some of them 20 to 40 bids out there, right? So, and many of these transactions are supporting kind of basic appraised value. So from transaction perspective, it appears we are close, especially in industrial apartment. But for sure, I think that there's something that we have to kind of see how play out is how the interest rate, higher for longer, can play out in the transaction market in the near future.
Sure. So maybe not quite out of the woods just yet, but definitely a different story across the sectors, and we'll certainly get into that detail. And then potentially where maybe on the face of it, the concern now lies is maybe more on the cash flow side, the blue bars. Yes, the economy looks to be potentially heading for a soft landing, you know, having avoided the recession that was often talked about through the course of last year. As a result, you can see through the course of last year, a lot of those cash flows kind of stood their ground, so to speak, but the projection of those cash flows did start to get scaled back in Q4. That negative cash flow effect became progressively worse in the opening 3 months of this year. And so then for the first time in this current period of correction, the downside on values is actually more cash flow than yield related. And I guess given, Robbie, that historically when you look at this chart, that it's cash flows, the blue bars that have been creating value for real estate, kind of quarter over quarter, is that kind of dynamic more of a concern, or do you maybe see that as more of a maybe just a momentary setback? So your thoughts just high level around that at this stage?
Yeah, I think that the negative cash flow effect is kind of a combination of several factors, right, Phil? So as we mentioned earlier, inflation is elevated. It kind of work on both sides. Like get down that the other side is higher expenses, right? So higher expenses in majority of the property, right? So, and then in some property type and location, yeah, there's an overbuilding. I know that an oversupply that we'll talk about it that keep pressure on the income side. And finally, as well, with uncertainty with economy and basically put pressure on the growth side as well, right? So on the long term, though, I think that given the strength of U.S. economy, I think the cash flow should play out well in time, right? So U.S. is definitely looking better than the rest of the world this time around with stronger fundamental, right? So we also seeing that based on our discussion with market participants, there's a stronger interest as well from foreign investor, which I think will help provide the support for the real estate, the U.S. real estate, right? So, of course, not every property created equally. I think that's where we will discuss further today.
Yeah, so actually, and on that point, let's get into the variances across the sector, but thanks for those insights there. If we can move these slides on, there we go. So looking now across the variance in returns across the sector, quarter-on-quarter returns shown here. Confirmation there at top of those performance numbers, that return of minus 1.5. It's not an improvement on where things were at the back end of last year, but still negative, so still this period of contraction. If you look between Q4 and Q1, now returns in all sectors thankfully moving in the right direction, so improving on where they closed out the prior year. In terms of the rank order, we're color coding everything here. We've done this before, so folks hopefully getting familiar. Color coding sectors where they finish either north or south of the ODCE overall average. So start with the red, offices remaining the outlier, firmly rooted to the bottom of the stack, and actually being cast further adrift from the other sectors with a minus 5.8% rate of return. Such is the demise within the office sector that kind of pull back on the overall ODCE is that's the only one sector that's actually now coming in below the ODCE for the quarter. If you look into the other sectors, the apartments pace of decline there slowed down to minus 1.1%. So that's now gone from the red to the green zone. So that's now moved back ahead of the ODCE overall return. The industrial returns have eased off even more so, down to just minus 0.4%. Other, most of which is self-storage, is in exactly the same ballpark at minus 0.4%. And then you have retails maintaining their position at the top end of the rankings, where returns have actually crossed the divide and turned positive again this quarter, although there is some negative appreciation still within that number. So with the kind of exception of the offices really, which is still very much in the doldrums, it's definitely an improving set of results for the start of the year. And actually, while we're seeing an increased dispersion in returns from the best to the worst, which is that bottom set of numbers there, that widening is really just down to the offices. Take that sector aside, there's less than a 2 percentage point spread now from the rest. And actually on the next slide, you can see that dispersion better here, which we're just looking at the line series of those returns. So, and also illustrating clearly that kind of improving set of results from where things shook out in Q4. But with that green line, offices still cast adrift, and it's kind of that continual separation of offices versus the rest that really think stands out for me. But even when you throw kind of offices into the mix, the variance of the returns that we're seeing kind of play out now is nowhere near the expanse that opened up when the market was on its way up. And that's when industrials were way out in front, certainly in a league of their own. But it's not just that, it's kind of there were two tiers to the market. There was kind of the offices and the retails languishing at the lower end versus growth elsewhere. And if you then take the valuation movements that sit behind those results, it really does show the kind of the varying circumstances that have been playing out across the sectors and continue to do so as we got into these latest set of results. So what we're showing here on this chart, the sandbars, let's call that the peak, well, that's peak to trough, that's the current period of correction, that's the last 7 quarters, and that's where I've referenced before, 19.5% being taken off the value of real estate over that period. If you take appreciation back to the start of COVID, that's the purple bars, market values there you can see are down 3.7%. So any of that kind of prior upswing has now been reversed back out. And within that, you have office values in the latest period of correction down by just over a third, and actually nearing 40% written off the office market when you date back to the start of COVID. Retail write-downs, a little bit more dispersed, so you've got a 10% write-down in the current period of correction, another 10% when you take things back to the start of COVID, so 20% down overall. Apartment values currently down 20% in this current period of correction, but then that's balanced out by the prior growth period, so values on that purple bar are effectively back to where they were. And yes, the kind of industrial other, which is mainly self-storage, have seen value decline in this current period of correction down around 10%, but if you take the industrial values, they're still 50% higher than where they were 4 years ago. And here you're getting the real sense of dispersion, certainly on those purple bars, what's been playing out across the markets. There's kind of a 90 percentage point spread. We mentioned it before, from the top to the bottom. So you can get a sense immediately from here how kind of those allocation plays across the sectors could make quite a difference to how performance levels might be shaking out for individual portfolios. And that's the kind of detail that we get into conversation with our clients on a one-to-one basis, and want to start having those conversations more broadly across our entire network of advisory clients, and also then unpicking that appreciation as well. So let's get into that point again about kind of bifurcating that appreciation, again, those trends into those yield and cash flow elements. So let's start top left-hand side, the apartments. All those gains in that growth period have pretty much now been cancelled out. The upside, you can see, was a mix of yellows, positive investor sentiment, but also strengthening kind of fundamentals. The downside, the yellow bars, it's really the result of the step change in that interest rate environment for apartments, but coming at a time when those projected kind of income gains have just about all but dried up. Industrials, we showed from the previous slide, still net up, and that's courtesy of this kind of phenomenal gains during that kind of post-pandemic growth period, a period of rampant rental escalation, which being picked up by that cash flow effect. Down below, you've got the office and retails, more downside than upside, and offices still very much on a downward trajectory. But if you focus to the right-hand side of these charts, you can see how those decline levels have been tapering off in the opening 3 months of the year, and this is directly attributable to there being less pullback from those pure pricing metrics, those yellow bars. But that is in absence of any cash flow upside. And for both the apartments and the offices, you can see the downside on values there is now more cash flow than pure pricing base. And the industrial cash flow has also petered out to pretty much a standstill, bringing to a close those record period of gains. So it's really only the retail sector which is offering any upside when it comes to cash flows, and that's still pretty muted in the wider scheme of things. To complete the set, the next slide takes the other grouping, of which now separate out storage. They're the largest subcomponent of that. I think they account for around 50% of that grouping. And here, same thing again, rate rises, as everywhere else, have eased off. but that cash flow element has started to peter out, and some of those demand drivers are started to be dialed back. So let's get into the detail of the real detail of the latest set of changes and analyze specifically kind of what's playing out within those yield and cash flow effects. So here you've got the cash flow effects, which are turning negative, specifically on the apartments and the office side, but it's the yields where the effect is more widespread and still lowering values in all sectors. And those yields quarter on quarter have done the damage. So this is one quarter. If you change that out for an image that covers the current period of correction, so going back over the last 2 years, you can see that pretty much all the downside on that appreciation is associated with those yield adjustments, with that increased cost of capital. Yes, the mixed set of results coming out in those appreciation levels is certainly being played out on the cash flow side, but it's yields that have done all the damage. So let's get into that detail first. And Robbie, looking here at those kind of discount rate exit caps, how much they've changed. Maybe you want to talk to this one. As I guess within the advisory network, you're seeing these numbers play out. And it's not just the levels that are being talked about, but also I think what's interesting here is the trajectory of those lines, especially as we got into the opening 3 months of this year.
Yeah, on this slide, we're looking movement on discount rate and terminal cap rate over time, right? So, and as you can see, the pricing basically in 2018, they're tightly bunched, right? So especially on the discount rate perspective. But if you look at now, it's actually that have been deviated basically between each of the property sector, right? So the most notable one I kind of look at is an office, Phil, right? So because if you look at it, that trajectory are still kind of not letting up, right? So it's still basically it appeared to be accelerated over the kind of a quarter or so, right? So and then the discount rate for an exit for office now exceed all property type, a lot of cases by 25 to 50 basis point, right? So and generally as well, if you look at all asset type, the pricing are definitely already higher than pre-pandemic level, right? So all the other sectors seem to basically, if you look at last quarter, the slope basically have been taper off, like so seem definitely have been easing off in the pricing movement there, right? So again, I think that's more reflective of what's going on in the transaction market, right? So there's transaction have been very competitive. We saw deal that client put on the market. Some of them getting like 40 bid. We're not talking 1 or 2 bids here, right? So that's kind of showing that the fundamental, like basically investor sentiment are back basically based on kind of what transaction out there, right? So granted, I think that the $1 trillion question is like basically how is the higher treasury basically plus higher for longer, how will that impact kind of the transaction going forward, right? So I think that for now, when we kind of starting the year, seems to be more optimism for sure, right? So, but that's something we will continue to monitor in the near term.
Yeah, and then those variances, I guess, and trajectories are kind of making sense with what you're seeing on the transaction side. Yeah, and actually, taking your point there about higher for longer, I mean, that all starts with the kind of elevated inflation levels. It's worth, I guess, keeping in mind that real estate has a pretty good track record in terms of cash flow gains, in terms of capturing those periods of increased inflation levels. But for now, the other side, cash flows have started to moderate. And so you can see that on opening that up on this next chart, we're seeing more downside than upside, but there's certainly variances there by sector. And this cash flow effect, for those folks who are familiar with the way we've analyzed their portfolios, we relate to a series of 6 kind of key appraisal metrics. The bars, this is for the quarter change, show the quarterly change in those. There's no perfect science to this. You can't sum up those changes to equate to that cash flow effect, but it gives you a sense of what's having a positive or a negative impact on those forward projected cash flows. And we're certainly seeing a lot more red and greens on this card than we've seen in prior quarters. And in fact, Reuters and says the only sector where cash flows are ticking up. Here we've got improvements in contract rents and market rents, and actually no scaling back of those growth rates. And actually, in fact, if you add down here the charts below, we've seen those growth rates for retails, that's that yellow line, progressively step back up, while all other sectors, those growth rates have been continuing to be dialed back over the most recent quarters. For Industrials and other, most of which is self-storage. What's notable, I guess, here versus the apartments and the offices are the contract rents and the market rents. They're still very much on the rise, which has helped kind of keep those cash flow levels, holding their ground, so to speak, over the quarter. It's the apartments, it's the offices where those revenues have come to a bit of a standstill, and actually we're now seeing those kind of face market rents, the red there, come down a fraction, added to which you've got the scaling back of the growth rates, and that's clearly downsizing those forward projected revenues that were being picked up in those cash flow effects. And this kind of lull in rental and the cutback in growth rates, it's coming at a time of rising costs, and that rising cost we're picking up in this year one operating expense ratio. So this is the proportion of cost to revenue for next year, and how that ratio is rising in all sectors, putting added downward pressure onto cash flows, but especially, I guess, the departments and the offices where fewer of those costs can actually be passed on. Then finally, on the cash flow side, add into the mix the increase in the budgeted capital costs, which is certainly a feature of the office market. We mentioned it before, picking up here the effects of increases in TIs and LCs. And actually, I think we could change the bottom chart down here to chart that over time. And you can see how that increased capital, budgeted capital investment has really come into consideration in this period of correction. It's almost doubled there over the last 18 months. So Robbie, any of those things stand out for you? And how do you see those kind of relative standings of the sectors based on these metrics?
Yeah, if you look at it, all the red bar in the expenses, in the expense ratio, right? So as we talk about like inflation, similar to the story, right? So it's a story in the news with higher for longer, kind of creating the rate kind of cut, kind of moderated, right? So and all that thing is higher expenses. And that if you look at it now, the property that cannot pass through these higher expenses are feeling the higher impact, right? So apartment and office being kind of the two sector that cannot pass through these higher expenses, right? So showing kind of more cash flow effect, right? So on the revenue front, I think that the office is definitely facing constant pressure, right? So if you go back a slide as well, right? So the growth rate had declined below the long-term averages, right? So and then you add on higher concession, higher capital, right? So that's kind of what causing a big kind of like a blue bar there for the office, right? So apartment, I think that's more near-term issue, right? So I think that's a near-term supply issue that's kind of impacting the rent and rent growth. And then you still get higher expenses, right? Just like the rest of the kind of property type as well. Industrial is much more dialing back what previously elevated growth rate, right? So again, I think that we'll discuss a little bit more as well. So it's appeared to be more short-term decline, I guess, or short-term pause, while we'd be dealing with some oversupply part of the market.
Yeah, so feels almost the apartments and industrials are finding themselves a bit of a new level, but the challenges are certainly there on the office side when it comes to those cash flows. And actually, if you think back to that, the full 2 years, the current period of correction, that's really how things have been playing out. So yes, you've got that kind of quarterly setback, but if you look at the last 2 years, outside the offices, cash flows in this period of declining values have been holding up and actually improving in all sectors. And you can see how offices down below kind of is at the trailing end in each of those metrics when you look back over the last 2 years. Contrast that, say, with the industrials, where in that current period of correction, market rents are still up. What's that? Over 30%, and that's what's provided a bit more of that kind of protective buffer to those values. Before we get into the detail within the sectors, maybe we just pause there. And do you want to pass over to this one, Robbie, and you can take through this question?
Sure.
I think they answered it before, actually. Yeah. So there's a question after that.
Yeah. This is the question that we asked before, Phil. Right. So in November we asked, when is the bottom? Right. So anyone that answered 2023, that's completely wrong already. Right. So we're at 24 now, so it's definitely not happening then. But I think majority kind of do answer like second half of 24. Some answer first half of 24, so you still got one more quarter to see whether it's bottom or not, right? So, but yeah, so now we're trying to refresh this kind of this poll, right? So let's go to the next poll. When will the value decline reach a bottom, right? So is it Q2 24, so this quarter, right? So or is it second half of 24, which is like the majority of you guys kind of basically voted this one, like in November, or is it first half 25, or is it second half of 25 or longer, right? So I'll give about 60 seconds for people to vote. If you, Phil, what will you pick, Phil?
Well, if we're going with the GFC analogy, then we've got a couple more quarters in the tank, so to speak. So I would be surprised at some point latter part of the second half of this year. But I guess obviously depends. There's two levers, isn't there? And what's starting to see some growth, and how much further downside some of the more challenged parts kind of are subjected to.
For sure. I think that yeah. Let's see what's the answer. Second half 24 still kind of like the largest one, and it first half of 25 as well. That kind of the second the second kind of largest side, right? So it makes sense, I guess, like to me, Phil. I think because the with the higher interest rate, it kind of shifted maybe a little bit, right? So if people thinking first half, now second half, the second half one maybe moved to the first half of 25, right? So
yeah. And I guess how much of that kind of cash flow is a short-term lull as well. So, but no, appreciate everyone providing their input around those. Let's get back to the return levels. So a lot of numbers on this chart. People are hopefully kind of getting quite familiar with it. This is where we're seeing how the returns have shaken out across the major metros. Order those from west to east. We'll go into each of these each of these sectors in detail in turn. So this slide just wanted to introduce kind of top level themes and some formatting points. So to explain just the color coding, the top table is all relative to that minus 1.5% overall ODCE operating return, total return. So we're getting a sense of what pockets are accretive or not to that overall ODCE return. The table below that, same setup, but for Q4. The lower part is then the difference between the two, where we're thankfully seeing more greens and reds on the cards. The vast majority of markets improved on their standing of where they kind of closed out Q4 of last year. So that's culminating in that slight uptick of 1.8% to the overall ODCE return between Q4 and Q1. If you focus on the kind of differences between Q4 and Q1, those top two charts, as I would say, observation-wise, a lot more green on the card now, especially when you're looking at the apartments and the industrial sector. Yes, there's still some red and some specific pressure points that just appear to be a lot more red in the prior quarter. So apartments and industrials clearly improving on their standing or their relative standing as we got into start this year, but it's kind of all relative though, and part of that is down to how much of the overall is being increasingly held back by the office sector. And the office sector here, the challenges look to be more widespread compared with last quarter. If you look to last quarter, more of a mix of reds and greens, so it looks as if the kind of downside was more targeted. And now we're seeing a lot more reds across the board. Retail sector, what's encouraging to see, a number of positive returns there, but it's not without exception. There are clearly some challenges still out there for retailers and specific assets, and that's especially evident when you look at some of these numbers. Denver, Chicago, New York, those ones are both down kind of minus 4% or lower. And other, a lot more greens and reds on the card, and here mainly most of that is a self-storage piece. Let's go into sector by sector. So let's start with the apartments, just to navigate you around this table. So what we're showing, first off, down the bottom there is up top, you've got the last 4 quarters culminating in Q1. Below that, you've got the 2 years, so that's, call it the kind of period of correcting down values. And then below that, you've got the 4-year, and it's an annualized set of numbers. So that's how performance levels, total returns have played out since the onset of the pandemic. To further confuse things versus the prior chart, we're now changing the color coding up, so the reds and the greens here are actually all relative to their respective sector averages. So you get a sense of where the leads and lags are within the sector. So focusing at the bottom, first of all, the 4-year, we've referenced it before. Here you see that kind of power shift that's had played out between the Sun Belt and the gateway markets that really took hold at the onset of the pandemic. But some of that is certainly starting to unwind. So if you look at the 2-year numbers, call it the current period of correction, the likes of in green now, New York, also in green, Chicago, along with Boston. So those markets are negative, holding out comparatively well, while there are at the same time there are certain Sunbelt markets which are being dialed back from prior more elevated levels, and you can reference within that. We talked about it before, Phoenix, also into that other grouping, which includes a number of the Sunbelt spots where there may be, I guess, instances of oversupply and affordability coming into play now. And we've mentioned it before, but what we're starting to see out, and certainly plays into the last couple of quarters, is that kind of east-west divide emerging, especially if you look at the current quarter and those numbers in the red for Seattle, San Francisco, also LA there with the lowest number for the quarter. So a lot of movement there since we started talking about this at the start of the pandemic, and certainly kind of an east-west divide kind of coming more into play. So Robbie, your thoughts around those trends?
Yeah, I think as we talked about it, I think last quarter, I think previous quarter as well, right? The East Coast, West Coast bifurcations continue to persist, right? So actually, you see kind of this quarter, like on 1Q, it's definitely seem more apparent. Feel like Snoop Dogg versus Jay-Z here, Phil. So East Coast, West Coast. No, not saying which one's better. There's definitely the bifurcation on their both sides, right? So the sun definitely did not shine as strong anymore in the West Coast apartment sector. I think it's much more reflection of kind of oversupply, right? So, and you couple with higher expenses, right? So, and then one market we did talk a lot as well as Phoenix, right? So in Phoenix, if you look at it, the vacancy was about 9.5%, right? So it was up from sub 6% in 2021, right? So granted though, I think the most recent data seemed to stabilize, right? So granted, still elevated elevated vacancy, but I think that the rent seemed to flatten out a little bit. But there's definitely still pressure on the 9.5% vacancy there.
Sure. Wasn't expecting the Jay-Z Snoop Dogg reference there, Robbie. Well done. Right, let's I get myself back on track. If I zero in within that, actually, if you look at between the last couple of quarters, and the reason I wanted to put this on there, so you've got the yield and the cash flow breakdown for Q1 on the left-hand side. You got the yield cash flow breakdown for Q4, and really, I think, and we made it before. I guess the point I wanted to make here was how the reduction in value is now as much cash flow, blue bar, as it is yellow yield related. Whereas if you go back to Q4, the downside was way more on the yield side, and also the kind of those blue bars, that cash flow contraction is certainly becoming more apparent. So if we take that kind of cash flow effect just for Q1 and we open that up, this negative, which we're seeing pretty much across all markets, is down to those growth rates coming down in all markets, but added to which those face market rents are being lowered. We're seeing that in a number of the Sunbelt spots. Phoenix, Dallas is there. The other grouping, I mean, Seattle is there's a big spike, obviously, left-hand side. But we've also on the right-hand side got those universal increases in that operating expense ratio, pretty much in all markets. So here, to your point, picking up on that increase in operating expenses, which is certainly for now lowering those cash flow projections. So noting, I guess, those setbacks in cash flow, which is not just this quarter, but it's last quarter. How are you seeing the kind of general dynamic for the multi-family sector playing out for now, Robbie?
Yeah, I think for the investor that we discussed, right? So we discussed with generally the one that have transaction as well in the one quarter, that they're generally bullish on multifamily kind of mid to long term, right? So with inflation story, higher interest rates, higher cost of financing, a lot of new construction has slowed down significantly. Majority of the new development will not pencil out today, right? So and then you add on the lack of housing, higher cost of home ownership, right? So and all of this are basically very positive to multifamily, right? So granted, we have to pass through this near-term supply issue, right? So I kind of look at it basically in the mid to long term, right? So it definitely going to be a lot, like there's going to be tailwind on the multifamily side as one term, right?
Sure. And actually, While we've seen 2 quarters here of negative cash flow, I mean, again, to the point that you go back over that period of downward values, those cash flow kind of metrics are holding up pretty much in all markets over the course of the last 2 years, and you've got those green bars and those market rent deltas. So market rents have been strengthening over this period, counterbalancing that kind of scaling back of growth rates. Let's get into the detail then and pivot across to the industrials. Quite a lot kind of going on here, especially if you compare the kind of the 4 and the 2-year results. Now you've certainly got tapering off of lots of talk about Southern California, so tapering off there. That was clearly the prior powerhouse of the industrial scene. We're seeing kind of something similar in terms of tapering off when we're looking at New York and New Jersey. That market, they did start with a relatively encouraging start this year. Markets kind of more firmly entrenched the bottom of the end of the order with those kind of reds that's running through all of this. San Francisco, Denver, we've talked about before. But then on the upside, there's markets that look to be coming into their own. Miami, Atlanta, I think we talked those through last quarter, but also DC there is actually the lead performer for last quarter. So all 3 of those, seeing some greens coming through over the last few quarters as well. So your thoughts there, Robbie, on how those markets are kind of shaping out both on the up and the downside?
Yeah, I think that if you look at the top 3 market there, you have indicated, Phil, right? So the Miami, Atlanta, DC, they definitely, this market have shown strong fundamental. Basically, when we talk about Miami, Atlanta in the past quarter, right? So and this market also showing strong absorption in the past quarter, right? So Miami, in addition to kind of basically that strong absorption we talk about, vacancy around 2.3%, right? So that feel like an LA during kind of a couple of years ago, right? So as a result, at low vacancy, you get higher rent kind of going through to the Miami kind of industrial, right? So Atlanta started the year pretty strong as well, right? So absorption was more than 4 million square feet in Q1, right? So that's accounting for more than 40% of total absorption, I believe, in 2023, right? So similar situation with DC, strong leasing, declining vacancy. I think vacancy around 5% now in DC, right? So that all 3 market, I think that the strong part of it is as well as kind of come down to fundamental, as you kind of mentioned, the cash flow side of it, right? So on the downside, I think that the basically talk about LA and Inland Empire, right? So that's come from basically mostly lower market rent, right? So you can show in there, right? So in the next chart as well, right? So most of them are kind of near-term supply issue, right? So LA faced negative absorption in Q1, right? So with decelerating activity from the larger user, right? So Inland Empire have record delivery in 23, like that make it vacancy kind of basically up to 7%, right? So that's up significantly from like a sub 1% several years ago, right? So the positive part, I think that cargo is up in 1Q, right? So both Port LA, Port Long Beach kind of reported significant increases in the first 3 months. Then basically construction activity declined as well in Q1, like with almost no development pipeline in LA, right? So considering the infill kind of location to this market. Do I look at it though, Phil, even though this market have kind of a near-term challenge, investor interest for these 2 market actually has strengthened as well, right? So there's a lot of transaction in that market. Investors are bullish mid to long term for this market. The demand, while near term kind of a short term kind of impact, the demand kind of mid term to long term is expected to be strong, especially the supply kind of decline with the limited construction.
Sure. Now, I mean, and the general positive story for the industrial still comes through when you break things down as well, Robbie. So when you're looking just here at the current quarter, some of those cash flow effects are generally on the right side, still strengthening. Yes, you've referenced from the Southern California markets where you're getting some dialing back of that kind of those market rent gains that maybe got a little ahead of themselves. But generally the cash flows are positive. And you've actually got now, as you say, those strong markets. The number of those actually crossing the divide, seeing positive appreciation playing out in the last quarter. Let's move over to the offices. Slightly conscious of time, but I think we're doing okay. Offices, usual suspects are at the lower end of the order. we're starting to kind of get some pockets here in the sample, so we may want to think about how we kind of rethink the segmentation of the office market. We're obviously doing a little bit more of that, and we'll come to that in a second when we're bracketing things up in terms of the different risk categorizations. But just from a pure CBSA basis, it's the kind of usual suspects that are in the red, that are at the lower end of the order: Seattle, Chicago, DC, New York, San Francisco, still not great. And it's the Sunbelt sort of spots that have held out better in the darker green, the likes of Dallas, Houston, Miami, that other grouping markets where we're typically seeing a better utilization of the office space. But if you put the two quarters side by side, as we did for the apartment sector, you can look at the makeup of that value decline. And this is where you see, as with the apartments, that cash flow playing a bigger role in that value decline, the blue bar, not just in terms of the proportion, but also in the size of those blue bars in terms of the absolute impact on value. And actually, there's no longer any positive cash flow. Again, it's all negatives across the board. So kind of, to conclude from that, the challenges for the kind of from the fundamental side of the office market becoming increasingly more notable, and why those cash flows down. Well, first off, the growth rates are being trimmed back. Yes, there is some have versus have not when you're looking at the market rent change, but where you've got market rents improving, that's also been accompanied by an increase in the budgeted capital. So it's coming at an increase in budget expense. And as in most cases, we're seeing that kind of operating expense ratio with moving out, combination still of the increased cost, but also the kind of ongoing rental concessions when it comes to the office market. And down at the bottom, it is the larger metros with the reductions in market rents alongside everything else. So, fundamentals wise, is this in keeping with your read on the office market there, Robbie?
Yeah, fundamentally, right? So office continue to face significant headwind, right? So you look at report from Castle, kind of weekly occupancy for the average 10 cities stuck at the 50% range, right? So with peak day occupancy at 60%, right? So and therefore, like while leasing have improved in 24, we see negative absorption just because with low occupancy, right? A lot of major occupier continue to trim meaningful amount of spaces, right? So we also seeing kind of increase when leasing as well. We see increase in concession, increase in tenant allowance, right? So that's give a lot of pressure on the revenue side, right? So and then you add on basically higher expenses, that's making it basically continue negative cash flow effect. But just like any real estate out there, right? Just like any other stuff out there, when you have uncertainty, you're gonna have continued pressure on the pricing side as well. So I think that in this office sector, seeing both basically also cash flow and pricing just with uncertainty in this specific market, right? So
yeah, and obviously thanks for that, Robbie. Obviously, where we've taken this now more recently, and we're narrating this when we talk to our clients on a one-to-one basis, we're taking the interpretation of the office market one stage further. We're breaking the markets down into what's termed for the traditional office, red, amber, and green, low, medium, high risk. We're also separating out here the MOB and the life science, because that's part of the benchmark data set that NCREIF are categorizing up. The difference between, on the traditional office side, the high, the medium, and the low risk, is based on occupancy, lease term, and if you've got shorter leases, are they identified as some of the more challenged markets, which we've listed out here below. It's not a perfect science, but it gives you a sense of how to maybe kind of start to think about things and bucket them up. In terms of the weightings, about a third of the office market is classified as high risk, 40% is medium. You could have different shades of oranges within that, and 10% at low risk, and about 10% life science and MOB. That I was looking at the structural shift of this in terms of the weightings, how they're changing. It's not altering a great deal, I guess, because it's the value of that high risk bucket that's being written down the most, and you can certainly see on the right hand side the step relationship here played out on the appreciation levels over the last 3 years. And at the bottom end, those high risk assets losing kind of almost half their value over the course of the last 3 years. And then when we open that up on the next slide, into the various CBSA markets. When you're looking at the left there, New York, San Francisco, DC high risk, Chicago high risk, looking at more than a 50% value write down. And right-hand side, yes, you've got the MOBs, you've got the life science, and the greens, you've got the low risk. So that's going to be, to a certain extent, propping up some of those performance numbers that people are looking at, certainly within some of those CBSAs, but you can certainly see the level of distress that's been happening there on the left-hand side. So any thoughts around these variances we're looking at here, Robbie?
Yeah, I think the one thing that caught my attention is the number of kind of bar, like the red bar, that's basically more than 50% decline. I think that last quarter, there's no bar that's more than 50%, Phil. So yeah. Now there are 4 of them, right? So led by high risk New York City office, right? So these are massive losses, right? So you're talking about 50, 55%. And again, I think the look at as well, kind of quarter seem like basically the high risk continue to see this decline, but then the weighting become less and less, right? So when you roll them all up, you might appear, hey, office decline less, but number of individual assets might still continue to decline, could still be the same, right? So you just basically the weighting on some of this higher risks become lower, right? So I think the office will remain to be a topic for the rest of the year, just because there's uncertainty as we talk about.
Yeah, and actually that slide, the prior slide, I think that we were north of that -40, and we're now near that -50 in that high risk bucket overall. So yeah, there are clearly still the challenges within the office market. Retail's just final slide here. Now this is just for the 1 year. Pullback on values is on the yield side, but what's encouraging when it comes to retail sector, for those blue bars, the cash flows are generally in the ascendancy. Growth rates, to say, are ticking back up. I mean, they've come up from lower levels, admittedly, but they're moving in the right direction. Market rents are also generally on the right side, moving in the right direction. And with the kind of market rent to contract rent spread on the rise again, hopefully that kind of continues to bode well for that sector. Appreciate we're up against time. I know there might be some questions. If we don't get to them, we can always answer them, feed them back across everybody. These slides will be shared with everybody as well. There's one final poll question I think we want to just close out with, Robbie, and then pick on any questions that have come through.
I think that this is the question we always ask, right, every quarter, right? So I think that the I'll look at is, what do you expect the total unleveraged property return to be in 2Q, right? So is it some positive value movement, like so 1 to 2% positive, or is it some decline, like so -2 to +1, or is it -4 to -2, so it's a little bit more negative on appreciation, right? So than last quarter, or is it really that basically below 5%? So, but yeah, so that's kind of again, I think that the overall, like Phil, what do you think that is? Like, so I'll give about 60 seconds for people to vote on it, right? So.
I'm just gonna let others vote now.
Makes sense. So I think again, I think this is a interesting time right now, right? So because I kind of look at it, you look at it the transaction side. Like I know a lot of people say, hey, like the valuation, look at all different stuff in there. How could that be? But transaction have been pretty aggressive. I kind of look at pretty positive. So, and that number have been kind of showing basically supporting a lot of the valuation out there, right? So
I guess it comes down to how much further downside, and the office market didn't get any better between Q4 and Q1 as well. So that's
So let's see. Let's see what people vote. Same as last quarter. So basically 0 to -3% appreciation is 80%. So and everybody seem like it's going to be similar to 1Q here, Phil.
Okay, I'll start preparing the slides for next quarter already then. No, thanks, Robbie, for adding your feedback on all those points. We'll send this deck out to everybody. I mean, there's the concluding points, just going to repeat on what the main points that we've touched on. The deck will go out to everybody. I'm sure there might be a few questions in the chat box there, Robbie. If we've got a couple, we can maybe pick those up now.
The first question feels like when you said peak to kind of basically decline from peak, what quarter is considered peak in this analysis?
So we go back 7 quarters to I'm just looking back at my charts. So yeah, so 1, 2, 3, 4. So yeah, so we go back. We've had 7 quarters of declining value. What we haven't done is compensate for the offices maybe coming down a prior quarter. So yeah, we've taken that 7 quarters of declining value.
Yep. And then I think that the other question as well, I think that we thought about equity too, right? So we're persistently 20 to 25% equity and it's pressure on the valuation, right? So I'll take this one, right? So I know that the way I look at it is basically valuation is down on the bottoms up approach, right? So we're trying to reflect what people are transacting, right? So definitely pressure on overall. You see the decline basically on valuation already, like as what Phil indicated, like 7/4, right? So the one kind of interesting part as we kind of talk about, while we see the treasury is up, a lot of the economic may not be kind of basically showing up truly positive and some weakness in fundamental. The transaction side actually been pretty aggressive, right? So like a lot of the bid out there being pretty aggressively bid, like some, like I mentioned, some of them was like 40 bid, right? So it go to 20 bid in the second round, right? So you go like 4 rounds of bids, right? So and a lot of them are basically supporting the appraised value, right? So and I know some cases might say, hey, well, how could that be? The cap is low, right? So but that's the reality that as an appraisal facing, we have to reflect what transaction out there, right? So definitely, I think that there's still pressure, I think, on office side, but I think that the industrial and apartment from transaction point of view seem to be much more positive, right? So so that's on what the pressure on the valuation. Do you agree, Phil?
Yeah, no, definitely.
Yeah, I think there's question in there kind of basically talking about cap rate. They kind of like some people taking the income kind of return and capping it to make it feel like a cap rate. I kind of look at it cap rate perspective. A lot of cases when we look at year one, right? So I think that maybe Phil will add kind of the cap rate side in the slide that we'll send out. So it's easier then we can explain kind of basically the cap rate that we're seeing rather than just looking at the income return, right? So I think that might be the best way for us to address it. So.
We can add that in. We should also add in maybe the market cap rate as well when it comes to the industrial because of the spread.
Yeah.
So we'll put that slide in there.
Yeah, and then for sure as well, I think that the occupancy, I think is tied to can basically cap rate, the going in cap rate for basically office just because it's not stabilized. I think there's a question as well that what is the current occupancy for office, right? So and what's the stabilized occupancy? I'm not sure whether you have it in hand, Phil. If not, we'll address it kind of basically.
Yeah. We can send that out.
Right. So. There's one question basically, how does the tax rate impact the market, right? So how investors adapting to tax rate, do they don't punish a lot of the prices? So I kind of look at it like when property taxes for majority of the valuation out there, we do consider what's the assessment going to be, especially if we look at California, right? So this Prop 13. So in the tax perspective, we do consider that, right? So and then valuation perspective, the client do have tax consultant, like a lot of this data also incorporate into the property tax number.
Okay.
See real quick. Sorry, got a lot of questions coming in. It's not the chart is not easy for me to look at it, right? So life science, which category that's being categorized right now? Life science.
So when we talk to the office number up front on that return table, the kind of grid with the reds and greens, majority of the life sciences assets were being folded into that grouping for offices, which is why when we do the bucketing up, we break out the traditional from the life science and the MOB part. So when we provide this, we've broken the two out, but up front, benchmark numbers that we're still getting from NCREIF kind of still on the old subtype categorizations. They have moved across. There's clearly still conversations going on around the inclusion criteria. So hopefully we'll be able to segue this all across to the so everything's done on a like-for-like basis. But the majority of those MOBs and life science properties, when we showed that slide up front in terms of the sector returns, were in offices, which is why we separated them out as well when we get into the bucketing.
Perfect. Yeah, I think there's still a question. We will address it afterward, right? I know that we hit 11 o'clock now, right? So
sure. No. Thank you, obviously, Robbie, as always, for your added insight into that. Thanks to everybody to say that's been part of pulling this information together. We appreciate it. It's a massive list. Thanks everyone for dialing in and their continued interest. I think we had over 1,500 people registered for today's webinar. We will send out the recording and the slides to everybody. and we will confirm on that the date for the Q2 webinar. But no, thank you very much. Have a productive and a good rest of the day. Thanks everyone for your time.